Going to start this over, everyone. I apologize. I'm sitting there talking all happy. Cece comes in. My daughter Celia's challenge was making Dad look good. So she came in, told me that you couldn't hear me talking. So I'm going to start over real quick. So just happy Valentine's Day to everyone. I'm David Moore with Equity Advantage. We've got an hour of great material, but I just want to start off saying a great day, right? So my younger daughter lives in New York, and she sent a video this morning in the subway with this gentleman dancing along with this dressed up skeleton and with this beautiful music playing. Sort of put a tear in my eye this morning. So I'm getting sort of soft in my old age. But anyway, all my best to everyone out there today. And title of today's presentation is the 1031 exchange, what you need to know, what qualifies. And I just want to, right below our logo on the cover here, it says, you've worked hard for your money. We work hard to keep it yours. That's ultimately why we look at a 1031 exchange. You want to keep your equity intact, keep it moving forward. And, the beautiful thing, I'm just going to start off saying, and I've been talking about it more lately, but one of my dearest friends in the real estate world and just in life lost a couple of years ago. And when I moved to Oregon from California, he was probably the first guy I met in Oregon. And he sort of honestly took me under his wing in a few different things. Anyway, he said real estate's not a get rich quick scheme. It's a get rich surely but slowly scheme with one golden rule: don't sell in a recession. And if you look at yesterday morning, I was speaking on self-directed retirement accounts, and we're going to talk sort of compare contrast IRAs to 1031 with real estate. But I was looking at the group and I said, well, hey, where's the stock market today? And somebody in the audience put their thumb up, and it was, that was one of the worst days we've had in a long time. And I guess when I look at a retirement account and talk to somebody about taking retirement account money and put it into real estate, one of the big objections I get from Wall Street advisors is, well, hey, it's not liquid. What happens if you got to sell it for some reason, so on and so forth? What happens, RMDs, required minimum distributions, that type of thing. And the whole thing with liquidity is why is the stock market like a roller coaster? It goes up, down all the time because that instant liquidity. Real estate, it's sort of the lack of liquidity is a double-edged sword. But on the bright side, on the downside, if you had to liquidate real quick, you obviously can give some away. But if you look at the stability of that real estate, it's because of some of that lack of liquidity. You don't have the big whoop-de-doos that you do in Wall Street. So whether you like that or don't like that, I mean, that's sort of up to you. You can always give stuff away. But in today's world, anytime we're looking at economic hardships, I mean, typically there's a flight to quality. There's a flight to hard assets, tangible assets. And the funny thing, actually, it's not funny, it's irritating to me, is that in the financial investment world, real estate is considered an alternative investment. And I put it out there to anyone on this call or anyone in the YouTube world. And by the way, you'll see this on YouTube. If you miss it today, you need to go. That's fine. But if you look at it, what's the ultimate tangible asset? I'd say real estate is, and why is real estate, or for example, precious metals? Precious metals also considered an alternative investment. Can anyone out there name, and I challenge you to put in comments underneath, name older investments that are known to mankind? I mean, it's really just not that way. They shouldn't be alternative investments. I call them real investments. And the best thing about real estate in my mind is that you're not betting that it's going to go up. I just feel like when I buy a stock or something along those lines, even gold, you're betting that the thing's going to go up, or you're betting that inflation is going to give you some value there. Where the real estate, it gives you this bundle of benefits that are there, and we're going to talk to them in a little bit. But our job, if you look at Equity Advantage, and we've got, my brother and I started Equity Advantage in 1991. We put IRA Advantage, our retirement side of the business, together in the mid-2000s, and that was a result of our 1031 clients wanting access to more money to go buy real estate. But if you look at this stuff, it's all about keeping your money yours, having you work forward to get where you want to go. And the 1031 exchange is sort of like an IRA for real estate. It allows you to get out of something you don't want into what you do want, keeping your equity intact. And we're going to talk about all the benefits of that. But it's an investment decision. First and foremost, it's an investment decision. So I just look at it, and it really, if you look at 1031's impact, and every few years, I'll just, my father-in-law used to call them knotheads. I'm going to say the knotheads in DC, they go and attack 1031 again, and they want to take it away because they look at what they perceive to be a bunch of money or tax revenue they're losing. The thing is about an exchange, every time a property is sold, and we've got brokers on this call, we've got investors on this call, we're going to talk about 1031's application of benefits to both parties there. But if you look at a single real estate transaction, if you take 1031 away, market velocity crashes. And I'm not just saying this, it's proven. And if you look at throughout the time I've been in this business, we've got a couple states that have sort of danced in or out of recognizing 1031. And anytime a state avoids 1031 or says, no, we're not going to allow 1031 treatment on a state level, that state becomes a vacuum. Because why would I give up? If we're talking Oregon, it can be as much as 11% on state level. I mean, and what they were proposed a year ago, and for future context, this presentation is February of 2024. But we were looking at a tax proposal last year that would have made Oregon the highest tax state in the country, short of New York, if you make $20 million a year. So, I mean, it was really sort of a crazy thing. And actually, there's a proposal that needs to be fought right now on the Oregon State, they're debating in Salem, that would add another tax or increase the tax on both personal and real property. And I would put it out to our local politicians. You better look in the mirror and understand what you're doing, the repercussions of your actions, because people are already leaving this state. The majority of our transactions that are initiated in Oregon are leaving. They're going elsewhere, and for a couple of different reasons. One, it's the tax, and two, it's basic bundle of rights of ownership. I left the post office this morning. I was walking out of the car, and this gentleman, I didn't recognize him, but this gentleman looks over at me. He says, "Today's the last day of business for my family, a family-owned business of over 75 years, and today was the last year of business. That business is a jewelry store chain, and they finally said enough. They could not maintain their business in this state for a whole variety of reasons, but probably the biggest one was just their own safety. His brother had been kidnapped and held ransom to go, not ransom, but they literally took him to the store, ripped the store off and everything else, and the police just didn't do anything about it. There was he told me the story of a 30-carat a necklace that was stolen, and they had a direct picture of the guy doing it, and the police couldn't do anything about it. So you just look at the 1031 and why we implement it, whether it's to get you out of the investment that's outlived its usefulness into the next thing. Maybe you're tired of this region versus next. Maybe you want different property rights. Maybe you want different asset class. But it really opens up and gives you the ability to move from investment A to investment B, keeping your equity intact. And if you look at Wall Street, Wall Street sort of says, well, gee, we don't have 1031. Well, Wall Street's got IRAs and 401k plans. And the beauty of an IRA or 401k, if we look at the market yesterday, if you've got an IRA or 401k, you see the market drop, you put a stop loss in, boom, you go to cash. You don't have to ride that roller coaster if you've got that ability. But if you've got taxed money in Wall Street, every time you suffer through those whoop-de-doos, you can't sell the stuff because you're going to lose all of that tax revenue. And that's one of those big things too that we deal with an exchange. Sometimes somebody will say, a financial advisor would say, look, just sell the real estate. We're going to put it in Wall Street now because Wall Street's doing so great. Well, the tax ramification of that action, you might lose 40% of your equity to tax. That gain's going to be that rate anyway. How long does it take you to get back to where you were if you didn't do that? And I would say, don't do that. Maybe do a cash out refi of the asset, take that money, go buy the Wall Street stuff. So really, when we get into this stuff, 1031 is really, it's not a tax, legal, or escrow decision. It's purely an investment decision. You're doing it to keep your money yours, get you where you want to go. If you're the investor, every dollar you save, you've got $2, $3, $4 more to reinvest with leverage. And that makes a huge difference. And it allows you to get out of an investment. The gentleman that, to be successful in life, I really feel you've got to have have mentors, take advantage of the resource around you. It's a complicated world. You can't know everything about everything. And when we're looking at these different things, you've got to have a great team of investment professionals in your life. I'm going to say probably tax people are the most important in your life these days, because it's just, you lose so much to tax. So a good tax person, sometimes I have people say, well, gee, I don't want to, I'm going to do my own tax, or I'm going to use some tax preparer instead of the CPA. I don't want to spend the money for this person. And my position is, a good tax person's job is to keep your money yours. So having tax exposure is one thing, actual taxes owed is another. And really, we've got to look at this stuff. But you want good tax people, good legal people to make sure you're staying on the tracks with stuff. If we're talking real estate, you're going to have good finance people, great escrow officers. You're going to have brokers in there, and I'm going to throw ourselves in that team of professionals too. You probably, if you've got multifamily stuff, you might have a management company, but really get that team together, take advantage of the resources out there, and really lean on those people when you're doing those deals. But the guy that mentored us, my brother and I, basically he just said, when you're looking at real estate, before you ever buy anything, and if you see our seminars, you've heard me say it before, answer 3 questions. If you can't answer the questions, don't buy it. What am I going to make? How am I going to make it? When am I going to make it? And then you can make that investment. And for our friends on Bigger Pockets and all, with the the new Burr principle, that's not new. It's been around for 50, 60, 70 years. And that's how I got in the business, but we wouldn't do that repeat stuff. You'd do the repeat through a 1031 exchange. You'd always improve the property, get it to the point where it's going to do what you need it to do. You rent it out for a period of time. You can pull some money out via the cash out refi vehicle, hold it a year or two, then do an exchange. Because if you just buy a property and flip it, you're paying normal income tax on it. It doesn't matter how long you've owned that thing. In that situation, you're paying normal income tax. If you hold it for a year or two and now it's held for investment, at least you're getting long-term capital gains tax. But I mean, that can be as much as 40%. So really, you're going to burn yourself out doing that stuff. You really got to look at it and understand, talk to your team, understand the tax liability of a disposition and where you're going to go. And the 1031 is that tool on assets held for investment to keep your money yours, going where you want to go. Now, as I said a minute ago, 1031's really, it's an IRA 401k for real estate, but it's better because anything that goes in a retirement account at the end of the day, you have to pull it out. And when you pull it out, you're paying normal income tax on it. 1031, you've got the ability to exchange, deferring all your gain, and your basis goes forward. The tax, it's not tax-free. The tax exposure does not go away. It's tax deferred. But at the end of the day, as long as the last investment you've got, you're holding for long-term, you're going to be looking at long-term capital gains tax consequence instead of normal income tax on the retirement accounts. But it gets better. And so if you look at the second to last line on this page, you look at this world, and in today's context, I had to put in brackets because every few years, once again, they look at getting rid of this stuff. You got the ability to swap till you drop. All right. So what do I mean by that, David? What do you mean by that? Well, you can exchange through your life. You exchange it on an asset at the end of the day. You pass away. When your heirs receive that property, those properties, they get a stepped up basis, current market value. They can sell the next day and have no tax exposure. So that exists today, February 2024. May not when you watch this video. But back to that ultimate tax revenue on a 1031, or what the government perceives to be the lack of tax revenue because of 1031. Think about one transaction. All those people are getting paid, and you compound that over and over and over again because the liquidity allows those transactions to go. Now, the other piece that people don't understand, the politicians really don't think about, is the vibrancy of the real estate. All right, now understand, we're seeing problems now with insurance of older buildings. All right, I like BC properties. In a building, if I buy something and it's doing everything it's supposed to do, I really don't want it. I want to buy something and improve it, make it what I want it to be, and get that value add situation. So I'm going where I'm going with it, and then that comes back to those 3 questions I stated earlier. But if you're looking at this stuff, the vibrancy of the real estate community is based upon transfers. I mean, when was the last, if you're a broker, when was the last time you sold somebody a property where they didn't put money into it? So it really makes a huge difference. And we can all drive through a community and see the properties that are clearly unwanted or maybe not affordable for that current owner to take care of. Well, why do they own the thing if it's just falling apart? We don't want that to happen. We want to move forward with the stuff. But insurance is starting to be a problem with older buildings. And obviously the quality of the stuff dictates some of that insurability too. So really look at that stuff and understand how the 1031 works and impacts the quality of a real estate investment or a real estate community. It really makes a big difference with that ability to get in and out, keeping the equity intact and growing things. And it really is sort of changing. I see a fundamental change in the ownership of properties too, where bigger properties actually even going smaller. Last week we filmed a YouTube segment you can take a look at. It's not quite up yet, but it will be soon, on mobile home RV parks. I've got a good buddy that runs that division at CBRE. And we were just talking about traditional and owners of those parks and then the tenants in those parks, but we're seeing the larger parks had been institutional for a long time, but even the smaller ones now, the institutions are buying those things for a whole variety of reasons. So I sort of feel like with these in certain communities, the rights of ownership are dictating changes. The mom and pops that had historically owned these things can no longer deal with the rent control issues, everything else that's going on with these properties. You get a squatter in there, you can't get them out. And so some of these things, the level of investment, I guess the floor on institutional ownership keeps dropping. And when we've got local ownership, it means something. You keep the money regional, it is where it is, and middle class can own this stuff. But as it gets bigger and bigger, it's just changing. And 1031 is going to allow you to make those changes. And we have lots of people going out and basically getting out of the rental house they've had forever and going into institutional real estate investments like Delaware Statutory Trust, DSTs, or institutional TICs. There's even something called the 721 UPREIT where you can exchange into a Delaware Statutory Trust property. It's held, or property or properties, and it's held as such for a couple of years, and then that rolls into a real estate investment trust, and then you're free to sell those shares of the REIT at your leisure. Obviously, when the change from the DST to the UPREIT occurs, you're pigeonholed in. There's no way out without tax exposure, but you do have liquidity whenever you want to take advantage of that. I look at that sort of as the ultimate installment sale. We'll talk about that a little bit later. Real estate, why today? Cash flow. You're not betting it's going up, right? The cash flow is going to be there. Somebody else is buying the property for you. You got leverage, the interest deductions, mortgage pay down where your tenants are buying the building for you, or buildings, properties, depreciation, appreciation. You know, and at the end of the day, you've got 1031 to get you out of that thing you don't want into what you do want. And like I said, real estate is a tangible asset. It's the ultimate intangible asset. And I would say it's not an alternative investment. It is a real investment. The only way a piece of property, if it's unencumbered, is going to go away is if you just don't pay any tax on that thing, and it's going to take a while for the government to take it. But I don't care what stock it is, it could go away tomorrow. I mean, you think about what it is, something happens, and we've all seen situations where a company's great one day, golden one day, and it's gone the next. Where that real estate is, it's a hard asset, and it's going to be there unless you abuse the thing. Gain. So I said it's not a tax, legal, or escrow decision, it's an investment decision. Well, David, why are you talking about gain? Well, it sort of justifies what you're looking at, and the investment decision is that choice between, you've got a property, if you maximize the value of that property, if you have, you need to go someplace else, and the exchange is the vehicle, it's the conduit out of what you don't want into what you do want, maintaining potentially total tax deferral, but 1031 is not all or nothing. Well, what are we looking at tax-wise on a disposition? Well, gain has nothing to do with profit. I mean, you could lose a property. If you look at phantom gain at the bottom, we'll talk about that in a minute. That's a situation where you lose a property, foreclosure, short sale, walk away with no money, or maybe have to come out of pocket even money in a short sale situation, and still have a tax consequence. So gain is simply the adjusted sales price minus your basis. And the basis in a property is the purchase price plus capital improvements minus depreciation. The purchase price varies depending on how you got that property. If you pulled money out of your pocket to buy it, clearly it's the purchase price is that first number. If I gave you a property, that quote unquote purchase price would be what my basis was for you. If I passed away and you inherited the property, you could step up in basis. If you 1031 into it, you got basis carry forward. A home pre-1997, you had 1034. That was a rollover. You had a basis carry forward on the sale of your home. 1033, involuntary conversion. That's once again, a rollover as 1031. You've got basis carry forward in those situations. So the purchase price can vary dramatically depending on how you got that property. Improvements. So during the time you owned the property, you put lots of money into it. Everyone always does. As I said earlier, if you buy a property, you're probably going to improve it to some extent. So you're going to have, if you just pull money out of your pocket to buy it, you're going to have that purchase price plus whatever capital improvements you put into it. And something I'll just caution you on, and I do this every single day, I'm talking to people about this, is okay, during the time you've owned it, I'm sure you put money into it, you did do any capital improvements? Oh yeah, I did this, this, and this. So okay, did you write anything off? And he said, oh yeah, I wrote it all off. Well, if you wrote it off, you expensed it, it doesn't impact your basis. If you capitalize it, it does. All right. Depreciation. What's the deal with depreciation? Well, the government's position on depreciation is you should have taken it, therefore you did. Back to good tax people. I've had people own income properties, and let's say it's a rental house, and I ask, well, did you ever take depreciation? No, I never took it. Well, government's position, you should have taken it, therefore you did. So you might have a tax problem on something that you didn't even get the benefit of. So it's really important, you're working with good tax people, that depreciation component is a prime factor of ROI, return on investment. What do I mean by that? Well, what I mean by that is that if you even look at a rental house, all right, just look at a rental house and you look at, there's something called cost segregation we'll talk about. But if you look at a rental house, it's the sort of baby step of cost seg, all right? When you buy that rental house, you're going to have an allocation of the dirt, you're going to have an allocation of the improvements. What happens to the ROI if you jack up the value of the improvements versus minimizing the improvements? The more the improvements are worth, the more that you're taking depreciation, ultimately the better that ROI is going to be. Now, that's a simple example of dirt and improvements, all right? If we look at the office building I'm in, they're going to do a cost segregation study on it. And they're going to talk to somebody like my buddy Jonathan, and they're going to bust that thing up into a couple hundred components and do this cost seg study. And now you're really accelerating depreciation, and you're not going to get more depreciation over the life of the investments or your investment world, but you're accelerating all that, so you're tremendously changing the return on investment over the short term. If you're looking at Delaware statutory trusts, REITs, institutional TICs, all those things, typically they're going to use cost seg, so just be aware of that, understand that. And if you want to know more about cost seg, take a look at our YouTube channel. Just type in equity advantage, cost segregation. You're going to see a series of videos on this topic, and you can learn more on it. By the way, if you've got questions on even, let's say selling a life insurance contract, take a look at our YouTube channel. We've got information on it. Well, David, why do you have information on selling life insurance contracts? Well, maybe you need money to do something. Maybe you want money to go buy property. Maybe you need money to save a property. Maybe you need money to do improvements to it. That's why it's there. We've got information on CRTs, charitable remainder trust. Tina in my office worked in that space for a decade, and we've got videos up there on that. Once again, that doesn't have anything to do with 1031, but we just want to get information out to our investors and their team of professionals so they understand what's out there, because a 1031 exchange is not always the right thing to do. There's an opportunity cost to the 1031. That opportunity cost is you're forced into buying a property within a very short period of time, 180-day timeline. You've only got 45 days to find what you want. So back to gain real quick. Phantom gain. Phantom gain, the sales price on a property, if you lose a property to a foreclosure, let's say, the debt on the property is the sales price. So if the debt on the property is in excess of the basis, that difference that delta, the difference between the debt and your basis, is gain. So you can lose the property, get nothing out of it, and still have tax exposure. So we do, in recessionary times, we've done a bunch of exchanges for people where we're not isolating them from actual or constructive receipt of cash proceeds, we're isolating them from actual or constructive receipt of debt relief. So pre-foreclosure, the assets transferred to us. When it's foreclosed, it's ours, not the taxpayer. And then they've got the 45 and 180 days from that transfer date to find what they want. And the question or the answer to what their decision is really clear to figure out, because you're saying, okay, well, I lose the property to foreclosure, and my tax consequence, as I said, if it's a long-term gain, could be as much as 40%. If you go out, there's something called, let's say, even if you couldn't get a loan, at least if you're an accredited investor, still a lot of these things, maybe the foreclosure was on institutional property that was passive to you. Maybe it's recourse, non-recourse, I don't know. But whether it's there or not, if you're a accredited investor, you can always exchange into a Delaware statutory trust, which has debt there that you're just taking on. It's not recourse to you. You didn't have to qualify for it. So we have some DST sponsors that have what they call zero coupon offerings, and they're very, very, they're not very, very high, but maybe it's 80% loan to value. You're not going to get a check in the mail like you normally would. You're not going to get mailbox money like you normally would with those investments. But what you've done in that situation is, instead of coming out of pocket to pay the tax at up to 40%, maybe you're coming out of pocket 20, 25%, 30%, maybe even it's 35%, or maybe even it's 40%. You go into that zero coupon DST offering, at least you're getting something for it. And then during the life of that investment, it's going to be building up equity, and at the end of the day, you have something. So it's really pretty easy, question to answer. Do I want to just lose the property foreclosure and pay the tax to have that happen, or do I want to come out of pocket to go buy something and do the exchange in this phantom gain scenario with a foreclosure and get something for it? And then that's, you want to burn the money, you want to get something for it. It's pretty easy to answer that question. We're covering a lot. My job is to give you options, opportunities out there. You're probably going to walk out of this thing with more questions you went into it with. And I'm just going to tell you, give us a call. We're happy to talk any of these details with you anytime. Tax hits, we're not going to spend much time on this page. We're already a half hour into it. As I said, it could be as much as 40%. Typically, we're looking at Fed rates on larger investments at 20 and 25%, 20% appreciation, 25% depreciation recapture. State rates could be anything from zero, and obviously the zero tax states are the ones that are popular right now: Texas, Florida, Nevada, even Washington State, but there's a variety of them out there. And you're going to be in a situation where, if you've got a property in those states, you're going to save yourself a lot of tax exposure that you don't get you're going to get stuck with, obviously, in California or Oregon or any of the states with New York. And on top of the state and federal tax, you're still going to be subject to healthcare tax if you make enough money. So just be aware of that. And it's up to you to decide. I'm not going to tell you. It's, like I said, it's an investment decision. Do I want to pay the tax? Maybe this is the year to pay the tax. And as I said, the exchange is going to have an opportunity cost too, because you have to spend that money within a period of time with the exchange, where if you just sell, have the money sitting on the sidelines, and you've got a pot of gold to take advantage of opportunities at will, that's a pretty nice thing to have. So just be aware of that. If you're doing an exchange just to hide from the tax, maybe you shouldn't do that. If you're going to buy property anyway, why would you pay the tax? This is the map. I thought I'd taken this thing out of here, but this map, the gray states are zero tax states. So obviously they're very popular. There are also states probably where you have a little bit more right of ownership. So that makes them more popular. You're going to see a couple states there with banded stripes, like if you look at Washington, and it's banded because some assets have capital gains, others do not. Real estate, at least for now, in Washington State does not. Thank you, Washington Association of Realtors and others, for trying to keep that there. I think, really the government officials, the powers that be, they just wanted a piece of all that Microsoft money Amazon, so on and so forth. But at least for now, real estate's safe as far as the state level, capital gain there. These are things I hear every single day. They're wrong. They're the exchange fallacies. And one, like kind does not mean house for house, land for land. It never has. Like kind refers to the nature of the investment rather than the form. So you can exchange out of dirt into apartments and rental houses, into places to retire into, office buildings, industrial property, all those things. Even a 30-year leasehold interest in real estate is real property. Two, section 1031 does not require 2-year hold. Now, as I said earlier, we've got hundreds of videos on our YouTube channel. The most viewed video there is the 5-year hold. And that was a result of people just asking us about 5 years and go, why are people asking about 5 years? What are they talking about 5-year hold? And really, the only thing that's a 5-year hold in 1031 is if you exchange out of a property into a new property with the intent to someday move into it. So, and we're going to talk about converting assets from investment to residence into investment. And there's reasons to do both things. But the reality is, if you exchange into a property and you you need to hold that property for investment before you convert it, then you move into it, you live in it a couple of years. Technically, at that point, maybe a 3-year hold, you'd qualify for, it would satisfy your 1031 and it would qualify for 121. Well, the rules have changed. If you sold that property within 5 years of acquisition, it's going to be fully taxable sale. And even after the 5 years, you're going to be subject to something called the Housing Assistance Tax Act, which we'll talk about in a little while. 3, there's no limit to the number of properties relinquished or received. All right, so you can give up 1 property by 10, you can give up 10 by 1, you can give up 10 and by 10. It doesn't really matter. If people look at the identification rules, which we'll talk about in a bit, and they imply that there's a finite number that you can ID. But the reality is you can relinquish and receive any number of properties in an exchange. Number 4, people say, well, you can't carry paper. Let's say a land sale contract or note trustee, you can't do seller finance if you're the seller and do an exchange. You can buy doing an exchange, you can buy into a seller carryback situation, that's totally fine. Selling and carrying paper, you can, I'm going to stress this, you can do the exchange, it just gets greatly more complicated, all right? And I would say use a note trustee instead of contract if we're going to do that. But once again, you can't, and this is something I really have to stress, right? And there's a page on notes, but I'm going to say it now and we'll talk about more later. If you carry paper, if you close a deal and that note is yours, your tax consequence is baked. Okay, it's there, it's done. You can't do anything about it. The tax consequence is done. You cannot call us up when you get a balloon payment at that point to do the exchange. So if you want to do an exchange and you want to carry paper, we can deal with it, but that paper is going to come to us at close just as any cash would in that transaction. So don't think, hey, I can carry the note when the balloon's 5 years down the road. At that point, I'm going to call David and we'll do the exchange. No, can't do that. We're going to talk about notes in a reverse exchange, and that's a different situation too. We can work with those. 5, you do not have to replace debt in an exchange. Now think about our marketplace today. Think about the lending world, all right? You've got a reduction in loan to value. You may have a reduction in equity in a property if it's gone down a little bit in value, and now you're in a situation where you're having to add cash to a transaction. Or maybe you can't get a loan. Maybe you're giving up, let's say you gave up a property, $1 million property with, let's say, $500,000 in equity. You've got to go out and buy a new, let's say, roughly $1 million property with the exchange to be totally tax deferred, but you don't want to have any debt or you can't have any debt. So what I'm going to say is you can give up that $1 million property with $500,000 equity. You can go out and buy the $1 million property, have no debt in it, and you're totally fine. The debt can go away. Debt goes away 2 ways. One, by going down in value. That triggers tax. The other way debt goes away is by adding cash, which is going to be totally fine. All right. 6, 1031 is not all or nothing. So if you want to do partial exchange, that's fine. Maybe you've got a $100,000 loss in the stock market, so you want to pull $100,000 out of your exchange. Those things are going to offset. So you wouldn't have exposure in that, right? So when we're looking at an exchange, as I said, it's an investment decision. You can kick the ball down the road as long as you want. You can also trigger any tax exposure you want. It's not all or nothing. You want to do a partial exchange, you want to pull money out, you want to do something else, that's always going to be okay. Every dollar you spend over the basis on that relinquished property is going to be tax deferred. So if you had a basis of $500,000, you got $1 million sale, and you go out and you buy a $750,000 property instead of $1 million property, you're going to defer the gain on the difference between the $500,000 and the 750, and you're going to have exposure on the difference between the 750 and the million. Okay, the million net of closing costs technically, but you'd have a partially deferred exchange, and that's totally fine. It's not all or nothing. Defer what you want to defer. Live your life, enjoy your life, and then if that means you pull some money out, go take a trip, do it. That's fine. You can only get that money at settlement though, or after you've purchased everything you have the right to buy. So converting properties. So if I walk into a big commercial firm and I start talking about Section 121, the universal exclusion, they're going, gee, I don't care about 121. My clients don't deal with 121. We're doing big investment properties. So 1031 is what I want to hear about. Well, what do you think if you've got a client, you're a commercial broker, and your client's got a bunch of commercial property or investment property, let's say, what do you think the likelihood that they've got a big home is? And if you look at Section 121, that was put in place in 1997. 121, the universal exclusion on a home sale, offers an individual $250,000 exclusion on gain, a married couple $500,000. You can do that over and over again. You just have to separate those events by a couple of years. Now, if you sell a home that has gains in excess of that 121, the 250 or 500, I'd say today it probably ought to be $1 million, $1.5 million, something like that. But if you look at that situation, once again, if you're a commercial broker working with your people and you hear that, hey, your client's going to sell their home, talk to them about it. Hey, maybe you ought to move out of the property. Well, why? Why would I do that? Well, if you move out, now you season it as investment, you do so for, let's say, a year or so, then you sell the home, you're still entitled to that 250 or 500, the exclusion, because it just says you lived in it for 2 out of the preceding 5 years. The overage goes 1031. What's another option in that situation? Anybody out there heard of a QOZ or OZ, Opportunity Zone, Qualified Opportunity Zone? If you want to know more about that, take a look at our YouTube channel once again. Got a couple different series on those things. One of them's with buddy Greg Genovese, and another one that actually puts them together. The other series is with a great friend, Connie Rothbone, who's a real estate lawyer, and she puts those things together. And by the way, buying in an OZ doesn't mean you get that benefit, right? It's got to be structured as such. But that would be another tool to mitigate some of the tax exposure if you sold a home and the gains were in excess of 250 or 500. So it's understanding all these things. It's all about opportunities, options, things to work with to keep your money yours. And once again, that's why you have good tax people and a good team of investment professionals there. So when we're converting an asset, I just gave you an example of why you would want to convert a primary residence into investment. Well, there's lots of reasons to convert an investment into a residence too. So if you want to exchange in a property at the beach, retire into it, just hold it for a year or so, then you can move into it. And do that with the idea you're going to be there. Don't do it with the idea you're going to get rid of any tax, because as I said, there's number one, there's a 5-year hold, but even beyond that, you're going to have some other stickiness in that transaction. So I always say, what is it? And let me put this out to you too. Let's say you've got a duplex, half owner occupied. Well, pretty easy to say. If they're mirrored units, half of it's going to go 121. So you got a single asset with allocations 1031 and 121. So who makes those allocations? Your tax people along with you. So we just do an exchange of a portion of that asset. Now it's pretty easy to understand in that context. What about anybody out there that's working from home? You work from home. Your tax people say, hey, treat your home office as a home office, and now you're taking depreciation on it. We sell the home. If you've been doing that for more than 3 out of the last 5 years, that home office is either going to trigger tax, or you better do an exchange of that home office component of that sale. Something people don't think about. A large, let's say it's a ranch property. Now you've got the home and you've got the working land. The home's going to go 121, the working land's going 1031. So there's, I just gave you a variety of examples of single asset sale allocations, different directions. And on top of that, we can go, as I said, from residence into investment, investment to residence. And there's reasons to do both those things. David, how long do I have to do this? How long do I have to hold something to have it considered held for investment? Like I said, that 5-year holds the most viewed video we've got, and there's explanations of timing on that video. So if you're a broker, somebody's got a question on how long to hold stuff, you can point to that video to explain it. We'll get information out to you. But if you look at seasoning and how long it is, it really has to do with intent. We look at flipping property. I talked about flipping earlier. Flipping is not investing. You know, well, I'm an investor, and I hear all these terms. Well, I'm a wholesaler. I'm a retailer. Whatever it is. And bottom line is, you're just choosing to pay tax at one rate or another rate. And what you've done with it, how you've held that thing is going to dictate which category it falls in. I'm going to say, why pay any tax? So we're always going to be looking at, there's something, the Clarkowski court case, 9 points used to determine dealer status. That's going to sort of give us an idea of what you're looking at. I use that court case in 1031 exchanges for determining dealer status. I use that court case and those 9 points in my IRA 401k business when I'm looking at something called UBTI, unrelated business taxable income. Because if you're flipping properties, even if you own it with, let's say a Roth IRA, you say, well, gee, that's tax money growing tax-free. I can flip and have no tax. Totally wrong. You're conducting business, and that's going to trigger tax exposure, even with a Roth IRA. So understand what's there. So back to holding. If somebody asks me how long I'd like to see them hold the property, have it qualified comfortably for 1031, I'm going to say a year. That's based upon 2 factors. One, it's been proposed several times. 2, that's a break between short and long-term tax rates on assets held for investment. If you're wanting to push lines, it really has to do with intent. If you bought a property and somebody came in a couple months later, made you an unsolicited offer that was too good to pass up, I'm going to say you potentially could do that exchange. You're not going to do any of this stuff without talking and speaking with your tax counsel first, because you want them to approve whatever you're doing. Since there's no black and white answer, it's gray. You need to take advantage. Make sure your tax people and you are on the same page. You don't want to get an audit and have done something and your tax people had no idea you did it. Now I go, well, I didn't tell you to do that. So at least if you're on the same page, you can rationalize what's going on, and that's that planning piece. So don't call your CPA before April 15th, but take advantage of them before year's end, because having, once again, at the top, I said having tax exposure is one thing, taxes owed is quite another thing. So really get good, people. Use them. Don't just use them to file your return at the end of the year. Use them for planning. Take advantage of their knowledge. And I always like to say, I'm happy to learn, tired of being taught. I want to take advantage of the professionals around me to make these things work. So this receipt case is a situation where, and back to the 5-year hold, I hear people say, well, you got to hold something 2 years. That's what the code says. Well, 2 years is what the code says for a related party transaction. If I exchange a property with my brother, a kid of mine, a related party, then we can do that exchange, but we need to each hold our respective replacement properties for no less than 2 years. Now, if you read the fine print, even in that scenario, it's not an absolute. If you can document there was no intent to avoid tax, then you could still possibly sell the property before the 2 years. In a related party transaction, typically we can say, we do say that you can sell to a related party in exchange, but you should not buy from a related party unless both of you are doing those transactions. But like I said, if you read the fine print, it says unless there was no intent to avoid tax. Now, it's 1031 avoidance or deferral. It's deferral. So you just sort of have to look at that thing. The receipt case was a situation where people bought a property, held it for 4 months, moved into it, and then argued. So they documented the listings for rent, documented the showings, and they argued it was a hardship situation. They couldn't afford to hold both property, their primary residence and the income property, while it was empty. So they decided to move into it. They got audited, taken to court. They prevailed in court after 4 months. I would not want to lean on that court case, but that's an example of what is possible. When COVID hit, we had a number of clients in states where the governors were saying, well, gee, the tenants don't have to pay rent. Well, who's telling the bank to sit down? So we had people that couldn't afford to hold assets, and they would exchange out of those things that they just bought. And that, once again, is something in that situation. The intent was clearly defendable, that they were going to hold for investment. The circumstances of the world at that point dictated a different course of action. I like simple, 4 basics. got to be an exchange. What's given and received have got to be like kind, have to go across or up in value and equity, and we must satisfy continuity of vesting. So as far as the exchange, you're going to sell, you're going to buy what you want. If you sold the property, never touched the money, you had constructive receipt. In the phantom gain situation, I gave you the example of having a property foreclosed, and if it was yours when it's foreclosed, what we would do, if it was yours when it's foreclosed, you have the tax exposure. If it's ours when it's foreclosed, now we've isolated you from actual or constructive receipt of not the equity coming out, but of that debt relief. So it has to be an exchange. Somebody gives us something, we give them something back. What's getting received have got to be of like kind here. And I want to point at 10 o'clock, even a 30-year lease constitutes ownership of real property or lease with extensions to 30 years. But all these other things are going to be of like kind. And you've got the flexibility to go do what you want to do. And as I said earlier, it's never meant house for house, land for land. Now I see there's a couple questions up there. I'm steaming along what I'm going to do. If you've got a question, post it up there. We will be addressing those questions offline later, and we can get the questions and answers out to everybody. Napkin test. So 1, it's an exchange. 2, what's going to receive your like kind. 3, for total deferral, we're going across or up in value and equity. We call that the napkin test. You hear lots of people, as I said earlier, talking about, well, you have to replace the debt. It's totally untrue. You don't have to. And as I said, 1031 is not all or nothing. And the value and equity numbers are going to be the numbers net of closing costs. So whatever the gross sales price is minus normal transactional costs have no tax exposure. So brokers' commissions, title escrow fees, tax and legal fees, hour fees, current property tax prorations, and that's going to give you an adjusted sales price. And that's also, so it's going to reduce the sales price. It's also going to reduce your net equity, and you're going to go forward. Now, what about lender required repairs? Lender required repairs is not a normal cost, believe it or not, because it seems like every time we have a closing, you got something that has to be happening. But anyway, so what do you do with that? You might have exposure on the money going to pay for those buyer's requirements, lender required repairs, but your tax people probably are going to expense those items and end up netting you zero, net tax exposure, and that number might drop what you have to spend to get where you need to go also. But as I said, 1031 is not all or nothing. If you want to pull money out, you can pull it out at close or after you've received everything you have the right to buy. Vesting. So the fourth of those cornerstones is vesting. The person or taxpayer that relinquishes has to receive. Now, the biggest headache with any exchange is time, because from the settlement date, you're going to have 45 days to ID what you want to buy, 180 days to get it done. The vesting is the second biggest problem, and I'll show you how easily it gets to be a problem. So I'm talking to you from Oregon. Oregon's not a community property state. So typically I might have an investor buy a rental, then they get another rental, then they get another rental. Then their lawyer says, you know what? You ought to shove these properties into a limited liability company because it'll protect you. And so since Oregon's not a community property state, even spouses would be considered a partnership in a limited liability company in the state. If we go to California or Washington, then you're community property and it's not a legal partnership. And so, well, why is a partnership a problem? A partnership's a problem because a partnership interest is not exchangeable, and where we can do the exchange for that partnership. So the spouses give us the property as members of a limited liability company. They're going to go buy 4 units or less. What kind of loan is that going to be? It's typically a residential loan. Maybe a large commercial property requires a limited liability company, and a residential property, they don't want you to have the LLC. Which is really sort of something I think the lending world needs to figure out, because it doesn't isolate the borrower from the obligation to pay. It just protects that borrower from liability on the property. So why wouldn't they want you to do that? Don't try to make sense of it, right? So it's just the crazy world. But so if that couple gives us a property in LLC, they go get financed, they're going to want to probably go testify entirety on the acquisition, and then their lender might even say just shove it back in the LLC later. But that transaction, that would be problematic, because the partnership relinquishes, we have to give that taxpayer that relinquished, that same taxpayer has to be the buyer of the replacement. And that's how easy this vesting issue gets to be a problem. Partnerships. So how do we fix that problem, David? Well, you do a drop and swap or a swap and drop. A drop and swap just means we're going to break the entity into typically a tenancy in common predisposition, and then everybody's free to go do what they want to do. Ideally, you do that probably a year before disposition so you can season the property as being held for investment pre-sale. Reality is most of the time it happens at close, you've got vulnerability because even though that entity, that partnerships owned the property for investment for years, you haven't. So if it's 9 times out of 10, that thing might happen at settlement, and you're going to have the purchase sale agreement either assigned or maybe you tear up the original PSA and write a new one. So you're going from the partnership to the buyer, you're going to have a new PSA that says the tenancy in common is selling to the buyer. There's a variety of different options on this. We'll do another video or another presentation talking more on partnerships. Swap and drop just means, hey, we didn't have time to figure this out predisposition. We don't like the risk of doing the drop pre-sale. So we're going to go out and buy, let's say 3, 4, 5 properties for the partners. The partnership's going to buy each of those. Maybe we buy each property in a different limited liability company. And then a year or two after acquisition, we do assignments to each of those respective owners for each of the properties they wanted. So that's a swap and drop. But this is one of those things. If you're a broker, when you go out, I'm going to tell you, maybe you get a listing because of 1031. Maybe you get a listing because you gave that person one bit of information somebody else didn't. But this is a situation when you first have that listing appointment. If you're a broker with the exchange, how do you work the exchange? One, you find out exactly what they want when you list that property. Start finding it, right? Because that's going to give you a big leg up on waiting till it closes and only having 45 days to figure it out. The other thing is maybe you see this problem with this ownership. You got 4 or 5 people in this LLC. Ask them, hey, is everyone going forward together? And if not, you want to mention this. And you don't have to know everything about it. You say, hey, I understand partnership interests are not exchangeable. If you guys are going different directions, you probably ought to talk with your tax and legal people about how to break this thing. Call the accommodator and talk to them about it because they're going to help you get where you want to go on this stuff. But that structure is really important to understand. Partnership interests are not something that qualify for 1031 treatment. This page is something I think is really, really critical in today's market. All right. This is something called 1031 G6. When can you get your money out of a transaction? And you can't, if you engage us and we close the down leg and now we have your money, we cannot legally give you your money. If you say, David, you're 2 weeks into it, I don't want to complete the transaction. Well, I understand that's fine. You don't have to complete the exchange, but I can't give you your money until you've purchased everything you have the right to buy, which means at no time prior to midnight the 45th day, because you have the ability to identify and buy anything you want inside that 45 days. After the 45th day, I can give you the money after you purchase what you have the right to buy. So if you ID 3 properties and you don't have any restriction on number of properties to buy, I can't give you the money until you've closed on all 3 of those properties. It doesn't matter if somebody else bought them or not. You're stuck. All right. Now on our ID form, we've sort of taken care of a little list because you might ID, let's say 3 properties. There's 3 different rules for ID: the 3 property rule, 200% rule, and 95% rules. The 3 property rule, and this sort of comes back to why people think there's limitations on what you can relinquish or receive. Well, the 3 property rule is very clear. You can ID up to 3 properties at any value. The second one's the 200%. You can ID more than 3. Total value can't exceed 200% of the relinquished property's value. Third says you can exceed 3. You can exceed 200%. You got to close 95% of the aggregate value of all properties ID. That means you're buying everything you've identified. Now, on our ID form, it gives you those options, and then there's a blank in there, and it says, in a paragraph, it says, I have identified these properties, but I reserve the right to only buy X. So you could ID 10 properties, but you say, I am, well, 10's not a good example. Let's go to 3 because the 10 is going to put you in the 95. You're going to have a problem there, unless the 10 were under 200% value. So let's just go with the 3. You ID 3 properties and you only have, you don't want to buy all 3, you want to buy 1. You're going to put 1 in that blank. As soon as you've closed the 1 and you're outside the 45 days, I can give you the balance of your money. Now, the other thing I'm going to tell you about this is do not get to the 45th day. On day 45, you're totally committed to completing the exchange, or you should terminate the transaction. Well, why? Well, because If you ID something just because on day 45 and now on day 60 you find exactly what you want, I can't give you the money. So really, you're sort of baked at that 45th day. You're either committed to completing the transaction or you should terminate it and get the money out, and then you can go do what you want to do. That's really the bottom line on that. Notes, seller finance, as I said, there's 5 different ways to use an exchange in a 1031. Number one, the note has to come to us at close. As I said earlier, you can't get the note and then when it balloons, choose to do the exchange. You're done as soon as you receive that note. So at settlement, the note's going to come to us. We're going to be the beneficiary of it. We could sell it to a third party. We could use the note to acquire replacement property along with cash. We could, 9 times out of 10, number 3 happens. Our client buys the note from us. And you go, well, why would I buy my own note? Well, what you're doing is substituting cash for the note. Now you've got a note that's giving you the benefit of whatever the term is. And I've had people borrow money from the bank to buy the note because that note's probably paying you in today's world. Maybe it's 7, 8%. Maybe it's, if it's wheat or something else, it could be 20%. So, maybe the cost of money at the bank is a couple points less than what the note's paying, and that makes sense. If you got money sitting in the bank, what's a savings account paying you versus what the note's going to pay? So we have lots of people that will put cash into the transaction, get the note. Now we've got the money to complete the transaction. 4, maybe it's short term. Maybe you've got a situation where the property's not financeable. Maybe your buyer was in an exchange and their 180 day came up, and in today's world, the lending went away at the 11th hour. They still want the property, you still want to sell. So maybe you carry them for 60 days. As soon as the note balloons, you've got the cash to complete the transaction. And the 5th option is that you've got the ability to do a partial exchange, and that comes back down to at what point, what's the floor at a number that ceases to make sense for the exchange. So every dollar spent, once again, over the basis represents tax deferred gain. So maybe if the down payment's in excess of basis, that allows you to defer some tax, and then the balance of it's going to come to you. Now, something that people don't understand. People think, well, gee, I'm only going to pay tax as I get the money. I pay tax as I get principal payments. Well, you're going to pay long-term capital gains tax on the principal payments. You're going to pay normal income tax on the interest component of those things. But what you need to understand is if you've got an encumbered property and you carry an installment sale and you don't do an exchange, you're going to have tax on debt relief and depreciation you recapture in the year of disposition, even if you don't receive a single payment. So you better get enough of it down to get you where you want to go, to cover all the closing costs and cover the tax obligation you're subject to at settlement. If you're doing the exchange, once again, we're going to get you taken care of. But just be aware of that, because I think that's something that really sneaks up on people and bites them. All right. Notes in a reverse exchange, think about this. All right. In a reverse exchange, somebody's got to have the financial ability to buy a property today to replace something yet to be sold. And if they got that ability, they're going to show up at the purchase with the money required to buy the property to close on it. We sign a note basically stating that we borrowed the money from them. We buy the property. When their property sells in the future, we take the proceeds, repay the debt. Any excess funds would be there to pay down the property, or depending on what format of reverse, maybe you go out and buy additional property with it, and then everybody's good. Well, if you carried so let's say we do the acquisition, we've got a debt to you of $500,000, let's say, and now you sell a property and you've got a $500,000 note there. That note comes to us. We can use the note to repay the debt we've got to you. So seller finance in a reverse exchange is not a problem at all. Seller advance or seller finance in a delayed exchange, if it's on the relinquished property, is clearly an issue there. And once again, buying on a seller carry in either format is always going to be fine. So we've got a delayed exchange. You've got the 45-180 both started settlement to get the transaction done or reversed. You've got the same timelines just from the date of acquisition. You've got 45 days from the date of acquisition to ID what's going away, 180 days to have it go away. A couple of things real quick. I just want to sort of stick in your mind, and we've got one example or a couple examples after this we're done. it is possible to combine personal money and planned money. So if you say I'm doing an exchange and I want to combine personal money and IRA or 401k funds into common property, if you're doing an exchange, it's going to require tenancy in common structure because, as we discussed earlier, that partnership interest doesn't qualify. But if you just want to pull money out of your pocket and go buy a property, combining personal money and IRA 401k funds, you can use either tenancy in common, or you can use common membership in an LLC, either one. As I said, if you're doing the 1031, it's going to require that we use a tenancy in common structure to get us there. QOZs, I just think they're important to understand, proper application. If you've got a blown 1031, you're looking for some life ring out there for some safety. The QOZ could provide you some. It can help mitigate any tax exposure. So let's say you've got a situation where you couldn't find what you want, you didn't do the exchange, or maybe you blew it, you didn't get the exchange set up. Look at a QOZ, and that might provide you some. It's going to alleviate some of your tax exposure. I sort of look at the OZs or QOZs as a Roth IRA. You got limited deferral into that thing, but whatever you make on it, if it held through the maturity, is going to be tax-free. So it's a pretty attractive thing for people. And once again, the OZ or QOZ can provide you and help mitigate some of tax exposure if you're selling a home with gains in excess of 250 or 500. If you don't want to move out season as investment, you can use that to help mitigate some of the tax exposure on a high dollar, high gain residential Section 121 home sale. A couple examples were done. This one really is just, a lot of times people come to us and it's not all or nothing. In a market like we're in today, don't think you have to defer everything. You might have losses to offset some of the gains. You might not care about deferring all the gain. Think of it from the context, and I said it earlier, every dollar you spend, your basis here, every dollar you spend over that basis is going to represent tax deferred gain. If you spend less than the basis, there's no benefit to the exchange. So I don't want to do an exchange for you if we're not helping you get where you want to go. All right, so there's got to be a reason to do this. These people came to us and said, hey, we're giving up a $3 million multifamily property. We only want $1 million. We're the replacement property. They went and bought $1 million rental house in the desert. So they went from 3 to 1. They've got exposure on the difference from 3 to 1. So $2 million in quote unquote boot as tax exposure, but their basis on that $3 million building was $250,000. So they still, that $250,000 was here. They spent the $1 million, so they deferred gain on $750,000, saved them $250,000 in tax. That makes sense, right? So don't think, hey, I'm not fully satisfying the value and equity numbers, or I've got some boot, I can't do the exchange. Totally untrue. Every dollar spent over the basis represents tax deferred gain. Second example, you're just in a situation where people were exchanging out of a higher tax property place, or a situation where the a rental, what's a rental house? You buy a 1,500 square foot rental house in Palo Alto, that's going to cost you $3 million. Well, what can you take and buy in another state for that $3 million? It's a huge difference. So in this situation, this is just an example of somebody that gave up a property, a vacation rental, actually like Tahoe, and exchanged out of that into several multifamily rentals and an apartment building, tenancy in common. So they went from one sort of vacation rental property into all of this other stuff. And you can just see how the power of the exchange allows you the flexibility to move from something that's outlived its usefulness into a variety of things and keep your wealth accumulating to get you ultimately where you want to go. So, as I talked about earlier, you talking about flipping properties in this situation, this transaction, it was an invest, improve, populate, refi, season, and then exchange out at a later date. TIC foreclosure, this is a phantom gain transaction. In this situation, and these are all deals we did. These are not just hypotheticals. This transaction, this institutional tenancy in common this is after the last crash, a phantom gain transaction. In these deals, you typically had a series of limited liability companies, tenancy in common. The servicing agent was predatory. So they were coming in, hey, we're going to refi the thing, make it work, make it work. I get a call from the lawyer. We got 20 people wanting to do an exchange because they've educated them about phantom gain. And pre-foreclosure, we did assignments membership interest from the taxpayer to us. When the property is foreclosed, it was ours. That transfer date is the date the 45-180 started, and they went from potential tremendous tax exposure to zero tax, got them where they wanted to go. But this is just something to be aware of, that if you lose something, it doesn't necessarily mean you just lost it. You could have a tremendous tax consequence, but it's not actually baked in until you just exhaust all possibilities. So this situation is just looking at a conversion of an asset. These people came to us, they had about $1 million tax hit. They were referred into us by a law firm. We said, move out of the house, season as investment property. You see my classes, you see them online, you can see this example, because I can't replace this example. It's too good, it's golden. So they went and bought 24 different properties, through the exchange. Deferred went from $1 million tax hit to zero. And a comment, by the way, you don't have to rent the house. You just have to move out of it and have it held for investment for a period of time. And that period of time is really what you and your tax people agree to. So don't think, well, I don't want to rent my house out, somebody's going to beat it up. Well, I understand that, but it's just got to be something that's held for investment, not resale. And once again, they closed all 24 properties inside the 45 because they didn't want to deal with the possibility of a sale fail and dealing with that 95% rule on the ID rules. This is the last example, has nothing to do with 1031. This is to entice you to take a look at our IRA presentations or listen to one of those. This, I think, is just amazing with respect to what is possible with a retirement account. And by the way, self-directed retirement accounts have always been possible. From the inception of retirement accounts in the mid-70s, you've always been able to self-direct. You've always been able to buy real estate if you want to do that. It's just one of those well-kept secrets. So in this situation, we had an elderly couple came to us, husband and wife, 2 IRAs, and they said, hey, we want to take our IRAs, go buy a mobile home RV park. Sure, fine, that's great. We'll do what's called a checkbook IRA, which really is a combination of a limited liability company and IRAs. And so what we do is we create a self-direct account for each of their IRAs. Each of those IRAs make the investment in a limited liability company. It's a manager-managed limited liability company. The member would be the trust company for benefit of her account, the trust company for benefit of his account. The manager would be the 2 of them in that situation, and that would empower them the ability to go buy the RV park. They could manage that park. The administrative functions, they can't go out and work on everything. Well, then they said, well, gee, we want to be the on-site managers and live there and have a job. Well, we can't do that with a checkbook IRA or IRA LLC or just a regular 401k plan. But we can do it with something called a rollover business startup, or ROBS. So instead of an IRA and LLC, it's a 401k plan and a C corporation. So we took his and her IRAs, rolled them into the 401k plan. We created the C corporation at the same time. The plan buys the corp bought the park. They got an investment, they got a job and a place to live, all with that transaction. I think that's a beautiful example of what is possible. So come listen to an IRA presentation. I think you get something out of it. Don't forget us. Only Dumb Questions is not asked. Take a look at our stuff. If you're needing help on something or you can't fall asleep some night, take a look at the YouTube channel. Our web page, our URL is 1031exchange.com. The most visited page on that site is the frequently asked questions, the FAQs page. So take a look at that stuff. If you're needing help on something, don't be afraid to give us a call. Don't be shy. We actually answer the phone. And we're happy to talk to you about this stuff. Even if you're working with someone else and not getting some direction, don't hesitate to reach out. I hope you found this helpful today. I wish everybody out there a happy Valentine's Day. I took about 10 minutes extra time. I guess I talked for a minute or 2 before I realized you couldn't hear me. Sorry about that. All my best to you. I look forward to hearing from you soon. David Moore, Equity Advantage, 1031exchange.com. If you need CE for this, once again, reach out to C Moore, CMOORE at 1031exchange.com. Thank you. All my best. Bye-bye.